Trump entered into office with a chance to really forge ahead with an agenda in the international arena and foreign policy arena. And, he touted himself as a deal maker, Mr. Art of the Deal. And he thought that tariffs were going to be the major lever of that. But I think he's largely misfired to date. He's bred a lot of mistrust, Mexico and Canada and Great Britain and the EU, because he went right out the gate targeting these other countries with pretty aggressive tariff agendas that didn't really seem to have a coherent message behind them.
The economic fallout from Trump's tariff policies has been swift. Economic projections now show a slowdown in the GDP. Last quarter's GDP already came in negative, but the Penn Wharton budget model predicts 6% GDP reductions, 5% wage decline, and $22,000 in lifetime losses for middle-income households. The economy has already contracted 0.3% in 2025's first quarter, like I mentioned. Uncertainty is spreading beyond Wall Street. Businesses and consumers are bracing for the impact. The consumer sentiment is falling to a multi-year low while the Federal Reserve faces mounting pressure from the administration, the Trump administration, to reduce their rates. So what is going to happen next? Joining us today is Phil Magness, Senior Research Fellow at the Independent Institute and the David J. Theroux Chair in Political Economy. Welcome to the show. Phil, good to see you. Welcome back, or welcome to the program.
Happy to be here.
I keep thinking you've already been on the show because I've seen you so many times in other media. You're great. So in my mind, you're back, but not
there
really.
We go.
It's your first time, and I'm happy you're here. Let's talk about your work and the consequences of Trump's tariffs. You're an economic historian by trade. Tell us how these tariffs that we're seeing today are different and or similar to the Smoot-Hawley tariffs that a lot of economists are making parallels to.
Absolutely. So we can go back in history, and I think I can start with the differences. And that is that tariffs in the 19th century were actually a multifaceted area of U.S. policy. They served not only to protect industries when special interest groups gained control of the levers of power, but they were also the major revenue source for the U.S. government. And that's obviously no longer the case with the income tax taking over, although there's some talk about reviving it. And yet the similarities are also starting to become pretty pronounced, in particular, as you mentioned, the Smoot-Hawley Act. Now, this was a extremely protective tariff that was adopted in 1930, right after the stock market crash. The major motive behind it is that they thought they were stimulating and protecting and locking down the American economy to save it from the international turmoil of what eventually became the Great Depression. And instead, what it did is it triggered an international trade war and was like throwing gasoline into the already raging fire of the Depression. So it probably prolonged it and made it significantly worse as a result of just a policy blunder. And I think that's where the closest comparison comes to today is you see Smoot-Hawley level rates that have been adopted by the administration, particularly the Tariff Liberation Day announcement from just over a month ago. We're actually pushing our average tariff rate into the same territory that they did in the 1930s, but it's also being done in such a way that I think risks repeating some of the same blunders because it's, again, triggering a trade war.
But are we going to get another Great Depression, which is what happens shortly after the Smoot-Hawley tariffs were introduced in the late 20s?
So that's the great uncertainty of the moment. I will say that our economy is much more diversified today than it was in the 1930s, although part of that diversification includes the fact that we're much more globally integrated on, raw materials and parts often are imported, even if they're used for domestic manufacture in the United States. So the ripple effects of the tariff could actually be much broader and much more significant than we felt in Smoot-Hawley. Yet at the same time, there are a couple other components that would need to take place to get a recessionary or Great Depression style event. Because the Smoot-Hawley, although it was a major blunder, it wasn't the only element there. They also had monetary mismanagement going into the Depression. There's a contractionary monetary policy. And they also later stacked on top of the Smoot-Hawley tariff in 1932, they passed a major income tax hike that was a contractionary fiscal policy. So all of those three things come together. That they created conditions that were very hard to overcome and break out of really for the next decade. So the question is, do we repeat some of those other blunders as well on top of this tariff? And I think that would determine quite a bit of what the next stage in U.S. economic development happens to be.
Let me just show you my screen right now. And this came in yesterday on the 5th of May. The
Yes.
New Civil Liberties Alliance, NCLA, filed an amended complaint today, adding several plaintiffs to the simplified versus Trump et al. Lawsuit against President Trump's attempt to rely on the International Emergency Economic Powers Act to impose tariffs on imports from all U.S. trading partners. Correct me if I'm wrong, but I believe this lawsuit is citing some of your work here. The amended complaint challenges the Liberation Day tariffs issued under the IEEPA. Can you just briefly summarize for us what is going on? What is this lawsuit about? And generally speaking, what is the concern regarding the livelihoods of the ordinary American?
Absolutely. So historically, Congress has ceded quite a bit of its tariff setting power to the executive branch. If you go to Article 1, fall very clearly under congressional domain. They're a tax power. But the courts have allowed them to delegate some aspects of that power to other areas of the government, especially in the executive branch. Now, historically, when they first did this, it started in the 1920s and 30s, some of these delegations, they had very specific parameters under the law that administrative agencies in the executive branch had to meet. So, for example, what eventually became we call Section 301 tariffs, there's a required regulatory review period where they bring in experts to determine if certain conditions are met that allow the president to then go ahead and implement a tariff. Trump did something very differently this time around. So instead of using these conventional approaches, he invoked a different law, and this is the IEEPA, which is an Emergency Powers Act from the 1970s. And Trump is interpreting it to give him wide-scale authority to just impose tariffs by unilateral decree, basically no review period, no expert input other than the president's whim, because he says he's operating under an emergency. Problem with IEEPA is it does not even specify the word tariff as one of the powers. It just says certain vaguely alluded economic powers that the president has, and there's no particular parameter that determines like a regulatory review or a process to implement these measures. It's just stroke of the pen by presidential executive decree. And the NCLA lawsuit, as well as a couple others that are filed in parallel to this, are challenging the constitutionality of that decree. They're basically saying Congress cannot, in fact, delegate, unregulated powers to the executive branch that do not have a clear, intelligible principle or set of guidelines set up in the legislation. And then basically, if the court holds this way, and I think there's a very strong constitutional case that Trump is acting outside of the law, that would strike down the tariffs that he has imposed so far to date and force him to go back to the drawing board and use some of those more conventional sections that have tighter regulatory oversight.
Okay, do you see this? How do you see this progressing? Is my question.
So the courts move very slowly, and they move essentially according to their own schedule. The fact that I think there are 5 or 6 now pending lawsuits. The NCLA one was one of the first out the gate and has gotten most of the media attention. But the state of California joined in and made a similar lawsuit against IEPA. And what they're trying to do is they filed in a variety of courts, and now it's kind of a process of seeing which court acts faster. And does it eventually hit the Supreme Court? I think it's a big enough issue that the Supreme Court at some point will have to take this up and adjudicate on it, and then it's really on their schedule. So one of the downsides for American consumers is this is a multi-month or maybe even year-long process to play out. In the meantime, the tariffs are in effect, and we're feeling the economic repercussions right now in supply chains, and eventually it'll be prices at the store.
Let's just go back to economic history for just a moment and talk about it before we talk about the future, Phil. So,
Yeah.
in your research, you've obviously looked at different periods in which the U.S. has enacted tariffs before, not just Smoot-Hawley, but before, during the dawn of the industrial age. Uh, America embraced a more protectionist measure. Some economists or economic historians have argued that the protectionist measures enacted during the dawn of the 20th century were partly uh, were not partly, but largely responsible for the growth that America has seen and the subsequent economic dominance that America enjoyed. Do you agree with this philosophy?
Well, it does not seem to be supported by the evidence, and this is something a period of U.S. history that I've studied very intensely is the late 18th through the end of the 19th century,
Mhm.
and tariffs are a major policy question. Then, as I mentioned, they were also part of the revenue equation, which did have something of a limiting effect on how far tariffs could go in cutting off the U.S. economy from the world. Because that's one of the tricks here is if you raise tariff rates too high, no imports come in, and then you can't fund the government in that era. But at the same time, we did in the late 19th century have a pretty high protective system in place around certain specific industries. Yet, if you go and study the data, you look at the growth in the tariff protected industries, and I'll use something like iron and steel. Those are the quintessential examples of sectors that get heavy protectionism both today and in the 19th century. And you compare them to non tariff sectors at the same period in the late 1800s. So, for example, transportation, electrification, these are some of the really dynamic areas of the U.S. economy that's growing rapidly. There's new technological innovation. You compare the two sectors and the growth rates, it turns out the non-tariff sectors are growing at a faster rate than things like steel and iron that are heavily protected from the world economy. So if this theory were correct, that tariffs are the mechanism of growth, we should actually see the opposite. We should see tariff sectors being the fastest growing components of the U.S. economy, and instead the evidence actually supports other areas of the economy are growing faster. That tells me that you can just intuit this that the tariffs are probably comparatively stalling some of these other sectors that they're imposed against, whereas relatively free sectors are much more dynamic, and they're the ones that are carrying the weight of driving U.S. industrial growth in that period.
Right. And do you think that this will have any impact on America's leadership position in the world aside from economics?
Yeah, unfortunately, it already has. Trump entered into office with a chance to really forge ahead with an agenda in the international arena and foreign policy arena, and he touted himself as a deal maker, Mr. Art of the Deal, and he thought that tariffs were going to be the major lever of that. But I think he's largely misfired to date. He's bred a lot of mistrust not only among potential foreign adversaries, but allies like Mexico and Canada and Great Britain and the EU, because he went right out the gate targeting these other countries, traditional allies of ours, with pretty aggressive tariff agendas that didn't really seem to have a coherent message behind them. And then not only that, he started vacillating on them, moved back and forth, would impose and then walk back and then reimpose and then walk back tariffs with market signals. Wall Street just collapsed every time he made a new tweet almost, and then would rebound after he rescinded the order. But it bred a lot of mistrust with traditional allies like Canada, Mexico, United Kingdom, most of the EU countries on the way that he rolled this out. And unfortunately, when he finally got to what he says now was his major target, countering China's aggression, both in the economic and military arena, other countries that otherwise would have been sympathetic to that largely distrust him because of the way that he handled those first couple of months.
Are you ready to meet the biggest minds in Bitcoin face to face? Well, this summer, the crypto capital of the world isn't Silicon Valley or New York or even Miami. It's Las Vegas. Introducing Bitcoin Vegas, the ultimate Bitcoin event of 2025. And this is not your average conference. Join real conversations with people shaping the future of money. Thought leaders like Michael Saylor, Lynn Alden, Ross Ulbricht, Winklevoss twins, David Sachs, and many, many more. Whether you're a hodler, builder, or just Bitcoin curious, BTC Vegas is where ideas ignite, partnerships form, and conviction grows in the space. Tickets are going fast, so lock in your spot today using my link down below or scan the QR code here. You'll get a 10% discount. Get it before tickets are sold out completely. We'll see you in Vegas. What is a more likely outcome if you had to pick a binary? A return to America as a hegemon, a world superpower, or the bifurcation of world powers from this, meaning several different power blocks?
Yeah,
Uh,
yeah. Well, I think we're actually heading into a multipolar world,
mhm,
regardless of whether Trump's economic policies existed or not. This probably would have happened regardless of who won the last election.
mhm.
Just the simple nature of things, we're well past the Cold War era of a free world versus the Soviet Union communist world. That was a very neat and tidy way of looking at the international dynamics. But in the current moment, we have several regional powers that have emerged, including new and growing economies. China is one of those, not the only one. So I think just the economic dynamics of a much more complex world were going to force themselves anyway. Now the big question is, where does the United States position itself in relation to some of these other economies? And even though Trump, I think, has pushed the tariff agenda as a way to assert American strength, it's largely backfired because it's bred ill will with allies and enemies alike. It's also threatened to imperil United States economic growth in the long term, as we're already seeing in some of these recessionary indicators that seem to be on the horizon. So both of those two things together really, I think, have weakened America's cards to play in the international arena vis-a-vis where they were just 3 or 4 months ago.
So paint us a picture for the average American household over the next 12 months. Suppose we don't have a reversal of the tariff policies anytime soon. And by the way, there's reports that Trump and administration and his allies are working on deals as we speak. But let's assume that no change is
Right.
expected and status quo is maintained. What does the average American household face?
Yeah, so I would welcome a deal if it lowered these barriers, but yeah, assuming we stay the course, assuming that the 90-day pause expires and reciprocal tariffs are back from Liberation Day, in addition to the 10% base that was already maintained from the Liberation Day announcement. So just to put that in some historical perspective, prior to Trump's administration, the average U.S. tariff rate on the rest of the world fluctuated between roughly about 1% and 3%. And that Liberation Day announcement, regardless of what he walked back, put in a baseline minimum tariff of 10% against almost every country on earth. So this is already a significant price increase. It's a significant tax that was imposed, and that's going to transfer through onto consumers. It's going to mean things that you purchase at the store are higher in price, either because you're paying the tax directly if it's imported, or you're having to pay because the seller has substituted to a domestic producer the same good at a higher price. So that's the first thing.
Yeah.
Second thing, the aggressive tariffs that he's taken against China and some of the other trading partners have already had repercussions in international supply chains. We're just starting to see them in this respect. Because you think about it, shipping from across the Atlantic or across the Pacific, this is a lagged indicator. There are multiple months involved in placing orders for 3 months or 6 months out from now for parts. And then plus it's a journey that oftentimes takes as much as a month or more to transit the ocean, cross the Panama Canal, and arrive into port. So decisions that were made 1 to 2 months ago are just now starting to be felt. And one of the things we're seeing is a reports of a very rapid decline in global shipping orders, in particular from China, but also other countries that we trade with. And that will start, being seen on the shelves around mid-May to early June or so. So we could have, artificial supply chain induced
Mhm.
shortages as a result of just the disruption in the way that this thing was rolled out. That moves a little bit later into the summer and the fall. Some of that will rebound and recover as the supply chains sort them out, but we'll still be stuck with the higher prices from having to pay costs on the tariffs. Now, major U.S. industries, even domestic production, it's estimated between 50 to 60% of U.S. industries use some sort of a raw material or an import from abroad, whether it's a part, whether it's steel or aluminum that goes into what they produce here. So they're going to face repercussions in higher input parts on their own goods, which will again be transferred through to the consumer. So we already see this in the automobile industry in particular, which use screws and parts and paint and sometimes raw material like aluminum and steel from abroad, even if it's a plant in South Carolina or Michigan or Tennessee. All of that will carry through into the price tags on the store lot, and we're already see some of the auto industry kind of
Yeah.
buckling up and delaying some of its decisions on how they're going to market new automobiles over the next several months, including possibly layoffs at some of those plants. Things get really hairy about a year from now because Trump has another problem on his agenda, and that is the Tax Cut and Jobs Act from his first administration automatically expires at the end of this year. And he really hasn't made much progress so far in Congress in terms of getting a renewal deal secured. He says he wants one, and they seem to be working on it, but nothing's materialized yet. So if that doesn't come to fruition, about a year from now, the country will be hit with an automatic reversion to its pre-2018 income tax rates, and that means our income taxes go up on top of all of these new costs at the store that we've had from tariffs. And that's kind of like the nightmare scenario for me because those are two economic contractionary policies piling on top of each other at a time when we're kind of teetering on the edge of a possible recession. That's what drives it. Assuming nothing changes courses and we don't get a tax cut renewal, that's what drives us deeper into a recession.
There was some misconception in the media in the past couple months about how tariffs actually mechanically drive up prices. Can you just explain to the layman watching here why it is that U.S. consumers pay the brunt of the higher prices? Because part of Trump's argument leading up to all this was that, well, if we have tariffs, China or other countries would be paying for it. But that's not really how it works, is it?
It's not how it works at all. So economists use a concept they refer to as tax incidence. And this is the notion that the person that's legally obliged to pay the tax is not always the same as the person that incurs the effect of that tax. And the classic example I'll use is like imagine a tax on tobacco or liquor. Most states have that, and they're imposed on the sale of the good at some point, either in the wholesale process or actually at the sale at the store. Even though it's a tax on liquor or tobacco, it's not paid by the liquor company. It's not paid by the tobacco company. It's actually passed on to the consumer at the store in the form of a higher price. So the incidence,
But who
even though
who
it's
pays the duties on the border?
yeah, so the duties are technically paid by the shipper as they arrive. They unload the goods, they pay it into they often place them under a bonded warehouse of some form that basically guarantees that a tax payment will be made.
Hmm.
So that's the merchant themselves are on the hook for the physical payment. But what do the merchants do? They sell their goods to a domestic distributor, and that domestic distributor gets them into the stores. But the merchant is able to pass on basically the burden of the tariff in a higher price when they distribute it to the consumers. So at the end of the day, the people that don't get to pass the price through into somebody else are you and me and every 330 other million other Americans that are shopping at the grocery store or shopping at Walmart that suddenly have to incur basically the bulk of the burden of this tax.
So you are expecting consumer prices to move higher as the CPI. I
Absolutely.
bring this up because last time Trump was in office, if you just take a look at the BLS CPI data, the inflation rate didn't move us significantly
Right.
prior to COVID.
Right. So it's not like an entire price level increase. It's on specific goods,
Mhm.
goods that are imported. So I differentiate that from like a monetary policy phenomenon of what we saw, especially during the Biden era with inflation. And this is actually driven by a whole complex set of other decisions that were made by the Federal Reserve.
Sure.
But this is like a tangible price increase on specific tariffed goods at the store that rise, and they come out of Americans' pocketbooks. Basically, what it means is that some of the best estimates that we have is a typical household will probably incur, like at the current rate, stay the course. Typical household will have between $1,000 and $4,000 more taken out of their budget just to cover the tax payment on these tariffs.
Phil, is the Federal Reserve stuck in a sense? Because on the one hand, you have tariffs, which by nature are inflationary, as you've explained already. But on the other hand, tariffs could induce an economic slowdown per economic projections. And so
Absolutely.
if they
So
were to stimulate ahead of a recession, they would have to do that now, but that would risk exacerbating inflation.
Exactly. So we have emerged, I think, from the Biden era inflation problems, and that did it was eventually tamped down because the Federal Reserve. What did they do? They pulled their levers that they usually do. So they raised interest rates. So their discount rate went up, and Jerome Powell has held this high because have been signals that it's a very tepid status quo. So, for example, even like December and January of this year, inflation started creeping up a little bit more than they expected it to, and that caused them to pause any rate reduction. So the Fed is kind of painted itself into a corner here in that they've exhausted that policy lever, that tool to contain the previous era of inflation. And in so doing, it means that they no longer have the same tool to go in the other direction as a stimulus mechanism. So monetary policy becomes much more constrained as a stimulus tool that could be drawn upon as like a counter-recessionary factor. And if inflation does start creeping back up in the middle of a recession, precisely because they started relaxing interest rates, started using some of those tools to their advantage, then you run the double risk of an economic downturn caused by the tariff situation, caused by potential fiscal policy contractions if the tax cuts expire, overlaid with a resumption of inflationary pressures. That type of a scenario, it harkens back to like the 1970s stagflation era. The economy wasn't really growing, unemployment shot up, and we had the dollar basically devaluing over the course of the decade through pretty high rampant inflation. So that again is like if you look to history, here's another nightmare scenario that if the perfect storm converged, we could stumble our way into.
Interesting. Phil, what do you expect the Federal Reserve to do? Not this week. We're speaking right ahead of the FOMC
Yeah.
meeting, but just carrying on our conversation. What is their appropriate course of action throughout the rest of the year?
Well, again, I think they're painted into a corner. Kind of staying the course is probably the most prudent move that they have at the moment in terms of preventing a rebound of inflationary pressures. But again, the recessionary risk here is actually caused by policies outside of that arena. It's caused by policies being undertaken by the administration through tariff disruptions, a potential fiscal contraction, and then also here's another thing overlaid on top of it. Trump really has not reined in the spending problem that was at the root of the last inflationary period. Trump has not taken full steps to make even the recommendations of Doge permanent. I know he just released a budget last week, but that budget itself, even though it had some cuts, they were offset by spending increases on the military side, and this is layered over, the existing status quo problems that we have on the monetary side because there are new debt and deficit financed spending pressures that could be coming down the pike, and that just further constrains the hand of what the Federal Reserve can do. Do they try to monetize that debt, or otherwise do we have a resumption of inflationary pressures caused by their failure to do so?
Right. Okay. Well, what is the market pricing of right now? Because right now we've been seeing a V-shaped recovery in stock market valuations ever since
Yeah,
Liberation Day. We saw what happened after that, and then we haven't recovered to new all-time highs yet, but it's on its way.
right,
Is the
right.
market pricing in basically a renewal of the 90-day tariffs? Basically, why are we having bullish sentiment? Because if nobody expects these 90-day extensions to last, well, shouldn't the markets be tanking some more?
Right. So there's the great uncertainty. What we do know is from basically February, right after Trump took office, until a couple weeks after Liberation Day, the markets were extremely and acutely responsive to every tariff announcement he was making. Whether it was the imposition of tariffs, then 600 points drop off the Dow, S&P tanks, and you can see it like down to the minute that he tweets it out. That effect is occurring. But then as he walked back those particular policies, there was a rebound. One of the interesting things that happened in the Trump administration is about a week or so after Liberation Day, and the Wall Street Journal reported on this. Scott Bessent, who's the Secretary of the Treasury, basically cornered Trump when he was away from Peter Navarro, who's the ultra protectionist trade advisor, and got him to do the 90-day pause. That 90-day pause basically bought a 3-month window of at least relative stability vis-a-vis what the previous months had been, the seesaw effect of on again, off again, on again, off again tariffs for almost changing by every 72 hours in some cases. So I think what the market rebound has shown since Besant was able to get that pause put in place is a resumption of stability, at least in the tariff policy, although there's still longer term uncertainty about what exactly happens after the 90-day pause expires. And Trump has signaled in both ways. I think markets are hedging their bets that Besant or some of the leveler heads in the administration can temper down and moderate figures like Peter Navarro or Howard Lutnick, who have been much more aggressive in pushing for retaliatory tariffs, pushing for aggressive protectionist tariffs, tariffs of all sorts, you name it. So I think they're really kind of betting on what happens internal to the debates inside the administration. And insofar as the moderates seem to have the upper hand after that 90-day pause, it's a calming effect.
Mhm.
Now that goes out the window in a couple months, or I guess now a couple weeks. Then we see a resumption of that seesaw pattern that we had in most of February and March.
Okay. Excellent. Phil, thank you for your discussion. Good
Absolutely.
analysis. Where can we learn from you and follow your work?
Absolutely. So, independent.org is our main website where we publish. Also, antitariff.org. This is the location of our economist's letter to the administration urging them to take the off ramp to back away from this protectionist policy. And we also have commentary that's posted up there that walks through the arguments for free trade and some of the evidence of why these policy decisions are particularly playing with fire. They're very dangerous at the moment.
Phil, what do you think, before we end, what do you think is the most likely base case scenario?
Well, great uncertainty at the moment. I am hopeful that the president is responsive to market signals because clearly the stock markets do not like it when he imposes new tariffs. Clearly, other signals that we're seeing in shipping, international shipping, supply chains, and eventually prices are going to show even further that the market doesn't like it. And then you add political popularity. Already, the opinion polls of Americans are showing that greater than 60% are opposed to these tariffs. That factor together, you bring all this forces together, and hopefully Trump will take the signal and start looking for an off ramp. That's my most optimistic. My greater concern, the flip side, the pessimistic side, is that someone like Peter Navarro continues to drive the protectionist tariff agenda, and Trump plows straight ahead without responding to those signals. And basically, that just drives us into greater and greater risk of a recession until that actually materializes.
All right. Thank you very much, Phil. We'll put the links down below, so make sure to follow Phil Magness and the Independent Institute there. Appreciate your time. We'll speak next time, Phil. Take care.
Absolutely. Thanks for having me.
Thank you for watching. Don't forget to like and subscribe.